Having enough income in retirement worries many in the LGBT community. So here at Queer Money, we're constantly exploring ways to help you grow your income streams.
Always looking. This is Queer Money episode number 568, and today we're joined by Christopher Price, managing partner at Boost Capital Group and CEO of Red Fox Multifamily, to discuss using part of your IRA to invest in hands-off, revenue-generating real estate.
Want to fatten that retirement account? Let's hear what Chris has to say. The mission of Queer Money is to financially empower the LGBTQ plus community. Join us in thanking Capital One for supporting that mission.
So this is a topic that we've wanted to dive into more deeply into for quite a while, and that is figuring out how to get more mileage out of our retirement dollars and diversify our investments with our retirement dollars. Because most people have most of their retirement money in a retirement account, but it seems somewhat limited because you can only typically, as far as most people know, invest in stocks or mutual funds or bonds and things like that. But there are so many things you can invest into with your retirement money, and that's why we have Christopher Price on today to talk about investing in real estate in your retirement account or in a self-directed IRA. So welcome, Chris, to the podcast. We're excited for a meaty discussion.
Thank you so much for the opportunity to be here to speak to your audience. I'm very grateful, and I'm looking forward to the conversation.
Likewise. So how does one invest in real estate with their IRA money or retirement money? It seems like I don't really see that option when I log into my Fidelity account, invest in a multi-level, multi-duplex property. So how do I do that?
This is such a great question, and it was something that I actually came across a little ways along my journey. So at first, when I started out as a real estate investor, it was all about what cash did I have available to invest in real estate properties to be able to generate a return. And what happened from there is, like most real estate investors, they run out of money. And when you run out of money, you start to think about, okay, where can I go to acquire some capital or to get some capital to then continue investing? And along my journey of becoming a real estate investor, where I started in single family home investing, I was also exploring and very much interested in investing in commercial multifamily investing. And then the great resources that are available for free out there online, like what you guys do on your podcast, I was consuming hours and hours of podcasts and listening to all of the audiobooks and watching all of the YouTube videos. And along my journey, I discovered that in fact, you can invest in real estate with your retirement funds. And this blew me away. And it was just in time, because what I was able to do was identify that when it comes to investing in real estate with your retirement account, you can actually roll over eligible funds from a previous retirement account, either a self-directed an IRA or a 401k, into a self-directed IRA or a solo 401k. So let me explain a little bit more. Let's say, for example, you were at a previous employer and you decided to pack up and move on to another job opportunity. Well, most people just think that the customary thing to do is just to roll those funds over into a Fidelity or a Vanguard account. And then when your new employer provides you with the ability to roll your 401k money from your prior 401k, you can roll it directly into the new plan at the new corporation that you're going to. But what many people don't know is that, in fact, you can roll those funds into a self-directed IRA or a solo 401k. For me in particular, the tool that I chose was the solo 401k, which provided, and specifically, there is a product called the EQRP. Now, I'm not here to market any product, but this was the product that spoke to me, because this tool provided me with the service and the capability that I needed to be able to invest in real estate to continue to diversify my portfolio, as you spoke to earlier, as well as be able to generate passive income into that plan. Now, the way that this works is that a specifically designed 401k is created for you to be able to roll those funds into this account. And from there, the key difference between, or there are multiple differences between a solo 401k and a self-directed IRA. The two key differences that I like to call out to our investors and to your audience is one, when you have a self-directed IRA, there's something called a custodian or someone called a
Mhm.
custodian. And that custodian essentially is an intermediary between you and the investments that you're interested in investing in. And sometimes they can, they may approve or not approve of those investments that you're choosing to invest in. On the flip side of that, a solo 401k allows you with the autonomy to invest in what you want to based off of your due diligence. And there is no third party custodian. And so you don't have to worry about any of those types of things. When you see something and you see an opportunity available to you, you can then pursue that and invest in that opportunity. And
Mm.
the other key difference that I want to stress is that there's something called UBIT or excuse me, it's a unidentified business income tax. So this in particular, this tax is applied to the IRA in particular, and when that tax could be substantial when real estate is acquired with leverage or debt when you're purchasing that real estate when it's an IRA. But a solo 401k, for example, does not have that tax implication. And so these are key differences that I want to make sure that investors are in particular aware of when they're choosing between a self-directed IRA or a solo 401k. And I must clarify, it's actually unrelated business income tax. So that's what UBIT stands for. Pardon me.
No,
Sure
that's
thing.
fine. You just that was a lot. Sorry.
It
Just
was.
have to take a second and digest that and maybe walk this through. So you're basically saying when I have the opportunity to pull to take money from my 401k at a former employer, I have a couple of choices. One choice is I can roll that into my new employer. One choice is that I can send it to an account like Fidelity or Vanguard, and that right there is the self-directed IRA. And then you say I have the other option, and that is the solo 401k. Those are the kind of the three main options that I would have.
Well, yeah, let me clarify just a little bit. So, in fact, there are many different self-directed IRA and solo 401k providers out there. Fidelity and Vanguard may provide those options, but in terms of the vehicles that you can invest in, it is typically limited to the products, the mutual funds that
Hmm.
they are marketing and selling to their clientele. When you roll your eligible funds over into your another self-directed IRA or solo 401k, you then have the ability to invest those funds into other assets. This is not just eligible for real estate investing, as I mentioned before. You can invest in things like precious metals. You can invest in, for those people who are crypto enthusiasts, you can invest in crypto with this vehicle. Other types of assets that are out there, but it really does open up the opportunity for folks to diversify their portfolios outside of the volatility of the stock market. And that's really one of the key things that I like to stress to investors.
Capital One Auto Navigator does more than just auto financing. We're here to help you find a car you love, too. Shop millions of cars from thousands of dealers nationwide. Research your favorite makes and models. Explore dealers near you and more. All on Auto Navigator.
Yeah, so I think that what we're most commonly know is that when somebody leaves an employer, they do a rollover IRA, and it goes into that kind of self-directed account, whether it's I have to buy specific mutual funds at that mutual fund company, or I put it in one and I can only buy stocks and bonds. But it does kind of limit the assets to ones that are openly traded on the market, right?
That's right.
Whatever that market may be. You're talking about this solo 401k gives you the opportunity to then have a much broader variety of investments that we can now invest in.
That's exactly right. And what I'm talking about in particular is specifically real estate assets. So many people think about investing in real estate, and they think about that single family home around the corner from their house that they can maybe fix up a little bit, put a tenant in it, and then they can manage it. And that's really active real estate investing, and not necessarily what I'm talking about. This is certainly a tried and true method for real estate investors who are looking to break in and get some exposure to real estate. But in particular, what I'm talking about when I talk about real estate investing, I'm talking about passive real estate investing into commercial real estate assets. When we talk about commercial real estate, specifically commercial multifamily real estate, we're talking about anything that is 5 units and up. And when we talk about multifamily, this is housing that is being provided. These are those garden style homes that you see around the corner from your neighborhood, with the nice amenities. They have the dog park, the pool, all the different things going on there. And those are the types of assets that we're talking about here. And folks can invest into these types of assets as what is known as a limited partner or a passive investor into these private placement investment opportunities. And what happens here is that when they invest in these things, when they become a limited partner, they get to essentially take advantage of being a real estate investor and take advantage of all of the benefits of real estate investing, but without any of the hassle, no active management. They're not dealing with what we talk about in the real estate space of dealing with the tenants and the termites and the toilets. They are able to be completely hands off. The 3 T's, that's right. It's all that stuff. They don't have to deal with that stuff. That's right. It'll stick with the folks that way.
Right. And to be honest, I think that's you bring up a good point there. I think that's one of the things that scares a number of individuals away from real estate investing is that they don't want to have that day-to-day management. They don't want to get the phone call at 2:00 in the morning that the toilet is plugged or that the there's a leak somewhere, or
what are you eating that you're plugging the toilet at 2 a.m.?
No, I don't.
Diet.
Anyway,
I'm curious with the self-directed IRA. As we understand it, you can't be a part of the management of the property in any way, shape, or form. You do even even taking out the garbage or doing the lawn or whatever, that actually does have to be all done by a third party. So you'd have to hire professionals to do that. In many cases, I think most people would probably just hire a property manager to handle dealing with all those additional workers. Is that the same case for solo 401ks?
That is the same case, because what you're doing here, the way I like to describe it to my investors when I speak to them is, think about your traditional 401k. It is invested into some mutual fund, and all of those returns are going back essentially to pay your future self in retirement. When you think about the real estate, the only difference is that instead of that 401k being invested into a mutual fund, it's being invested into a real estate property, and the cash flow and the returns are going into your future self as well. You can't deal in that directly when you invest directly with your solo 401k or your IRA, because that is not consistent with the IRS laws that they have available. There no self-dealing essentially is what they're trying to get after. So they want to control that and not allow for folks to use their retirement funds to be able to benefit from immediately or from a personal usage, so to speak.
Right.
Yeah, that makes sense, because if you're investing in a mutual fund, you're not the one who's managing the mutual fund. You're not the one who's marketing the mutual fund. You're not now granted, if you actually do work for a mutual fund company, you can still invest in that. But you can't, I like this idea of benefit personally, right? You're not the one who's fixing up the property. You're not the one who's managing the property. You're not doing all these things so as to maybe increase your return or to give yourself a kickback, right? I'm going to mow the lawn, but I'm going to pay myself $7,000 a month to mow the lawn at this particular property. And you can't take it. I think there's all sorts of ways that people could find a
It better look like a golf course where they've got the marks on it.
That's right.
right.
Crisscross.
There's this potential for all these loopholes in which people could essentially take money out of their 401k. But I think you also bring up a point here that you're encouraging, or what you do with your investors is that they invest in, they don't buy the whole property themselves, right? It's not like I have to have $7 million in my 401k to be able to go buy this 10 unit place and have the whole thing managed by somebody else and the property, all of that. You're saying that what happens is individuals are just buying a piece of this?
Oh, this is such a great question. So let me dig into that. So when you're investing, what we're talking about here is real estate syndications, for example. And in a real estate syndication, there are really multiple parties that are involved. The key parties that are involved are the general partner, or the operator, they're also known as. And these are the people who are going out there, finding the deal, they're analyzing the deal, making sure all the numbers work. They're making sure that the asset is in the right marketplace. They are creating the business plan for how they're going to go about improving the property. What do I mean by that? I mean, when they're looking at how can they increase the income of the property and reduce the expenses. For your audience out there, many of us have probably lived in a apartment complex before, and we have paid the fees for parking, for example. Just to park our car at that residence, we have to pay a parking fee. Or if we're going to remove our trash and have a trash valet, we have to pay an additional fee for that. Or perhaps there's a laundry. If you don't have laundry in the unit, there's a laundry facility down the hall that you use and that you have to pay to utilize. All of these are income generating strategies that general partners and operators put together to be able to increase the income of the property. But simultaneous, there's also efforts going in place to be able to reduce the expenses of the property. So many of us also may be familiar with those toilets that have a high water usage, for example, and that high water usage, it has a direct correlation to the expense when it comes to water maintenance and water management. And so when I've been involved in projects where we just simply swapped out the high water flow toilets, for example, with low water usage toilets, and that can save about a third on the water bill. So it's those types of things that the general partner is putting together, these things, improving the operations of the property. They are also going out and they are making sure that they can in addition to the business plan, they can organize the financing for the property. So that's not only the financing from the financial institutions, from the banks and lenders, that's also raising capital, private capital from investors who are interested in investing in great real estate deals, but not necessarily looking forward to getting their hands dirty and all those things. And that's where the passive investor comes in. So the passive investor, who loves the idea of investing in real estate and wants to do this, they get a chance to assess the operator and their track record first and foremost to make sure that this is someone who they know, like, and trust. But beyond that, they're also able to then assess, hey, does this deal what market is it in? Is the market growing? Does it have a diverse economy? Is this something that I'm going to be, is it in a town that's a one trick pony that if that industry leaves, then everyone else is going to be screwed? Those types of things are things that you think about. Are people, are people continuing to move there, or are people fleeing it? Is this in a up and coming neighborhood, or is this in the hood, so to speak? Those are various different things that investors would think about when they're looking at particular assets. And once they've done their due diligence, then they provide part of the capital that's used to acquire that asset. And when they do that, they then become limited partners or passive investors in the deal, and they can then receive monthly cash flow distributions from the revenue that the property generates. And then, of course, after about 3 to 5 years, when the business plan is executed and the property is sold or refinanced, that investor will not only receive their principal investment back, they'll also receive their equity multiple back. And what I like to tell investors is typically most investments aim to double their money, specifically our investments that we have. We aim to double investors' money in that time frame. So that's
In
just a
three to
big
five
picture
years?
about in 3 to 5 years. That's a big picture around how this
Wow.
process works.
Wow,
Wow.
that's so. Let me ask you. So, you're basically what you're doing is you're buying it when you're doing a real estate syndicate. You're buying into a somebody else's real estate business as kind of a partner, like you said.
Yeah,
You're a limited partner,
that's right.
and so you're investing in somebody else's business being successful and able to give this return. You're not necessarily buying into. I'm going to buy into and this syndicate, and we're going to hold this apartment complex or this apartment building for the next 20 years and get the cash flow that comes from it, and that being distributed out. These are a little bit more on the shorter term. Is that right?
Yes, that's right. They're typically the investments, the most typical investments that you will see are anywhere from 3 to 5 years or 5 to 7 years. There are some investors that do prefer to hold for a longer period of times, but and what we're for our specific strategy is focused on the velocity of money. But the idea here that we're talking about is there is an entity that is created, an LLC that is created that is set up to acquire the real estate property, and the funds that are raised from private investors as well as the capital from the lenders are used to acquire this asset. And what the passive investor is investing into that property, and they receive their proportional share of what they're investing in. And so in the returns that I described earlier, those returns, as I mentioned, it is their principal investment, but it's also the cash flows that are received on a monthly basis, which we typically annualize for the investors in terms of their cash on cash return. And then we talk about the proceeds from the sale of the property. So if you want to think about it, most of us are familiar with what we've seen on HGTV and the fix and flip shows. Think of it like a big fix and flip, right? The only difference is that instead of a one single family home here in a great market with the great access to schools and neighborhoods and all those different types of things, this is a 100 unit apartment building in one of the best neighborhoods in Dallas, Texas, which happens to be one of the fastest growing markets in the United States, for example. And we are able to execute that business plan and then generate a return and rinse and repeat that process on a consistent basis. That is the idea that we're having here. And again, this strategy may vary depending on those operators or partners that you're working with. Some folks, as I mentioned, do hold properties for much longer. Their strategy in terms of how they exit may be a bit different. For example, they may choose to, instead of selling the property, they may choose to refinance the property after year 5, for example, pay back the investors their returns as I described before, and then just cash flow the property from that point out, and everyone participates in that cash flow. So those are just some ideas around how this typically works.
Ah,
Nice.
interesting.
So you mentioned velocity of money. We've talked about velocity of money on previous episodes, but for our listeners who aren't familiar with that, can you define that for us?
Yes, so the idea behind the velocity of money in terms of how I focus on it is, your money stagnant is really not working for you. The idea behind the velocity of money is really being able to put your money your money, and in our case, from a real estate perspective, other people's money to work so that you can generate a return in rapid succession. So the idea of being able to, in the case of real estate, most of us are using leverage or debt to be able to acquire these assets, and we're able to invest that capital to acquire these real estate properties and generate a return. And the faster that we can get that return and put those resources back to work to generate additional capital, additional return, that's what I mean by the velocity of money.
Right. And so your strategy is saying use many of our listeners are pretty, doing pretty well financially. They're just looking for creative ways to do better, and of course to generate more income in their while they're working, but also have more income when they retire. So you're saying that with whatever money that they have from a previous employer, you're suggesting consider putting that money into a solo 401k and then investing in real estate syndicates. And this is maybe an optimal real estate investing strategy for those who want to get into real estate investing, but they've also got a full-time job, kids, spouse, all sorts of other things to juggle, and managing another property or managing a property or multiple properties is just a little bit too much work. Going with a syndicate can kind of take some of the legwork off your plate, and you can kind of just invest your money and let the other people who are professionals in that area kind of make the money for you.
That's exactly right. And the idea of it really is for those folks to be able to diversify. I don't want to lose sight of that, right? If you think about the old idea, the old adage of putting all of your eggs in one basket, when we are, whether we can argue this, of course, but when you're invested in the market and solely in the market, regardless of whether you're invested or diversified across different asset classes in the market, you're still exposed entirely to the financial markets.
Right.
However, when you take a portion of that capital and you continue with your investment strategy, let's say, for example, in the paper markets, in the stock market, but then you have a portion of your capital working for you into real assets such as real estate, which happens to be one of the tried and true ways that folks have built their wealth in this country, in the United States and around the world. This is what we're talking about, giving people the opportunity to diversify their portfolio, generate passive income streams to be able to help accelerate or turbocharge their retirement is really the idea that we're focused on here, so that they can diversify these things and not have all of their eggs in one basket. That's really the message and the strategy that I like to encourage people to think about.
Yeah, I definitely appreciate you talking about that, because that whole idea of taking everything you've earned from your previous employer's 401k, and putting all of that into real estate, that sounds like a rather risky endeavor. So let's say I leave an employer and I've got $100,000 and I want to split it. What is the minimum, or how much could I put into something like this if I had, let's say, I had that $100,000? Would you say do I put 5,000, 10,000, or is there a minimum I have to put in?
It's a great question. So I want to just briefly go back to just say, when it comes to these, we talk about passive investing. It's passive to a point, right? Thankfully in this, you are relinquishing your responsibilities to the professionals to be able to do the heavy lifting and all the things that we were talking about. They're taking the calls at 2 a.m. They're the ones, putting together the marketing plan to make sure that people are finding the property and coming and leasing up, and they're vetting all the tenants based on the criteria. That's such an important aspect of things, and I don't want to lose sight of that. But to your point, once that is done, and you, as I've mentioned, you've grown to know, like, and trust that person or that team that you vetted, then it becomes a very passive endeavor. And when it comes to the types of investment opportunities that you're looking at in this space, in the most common situations, you're looking at being able to invest in institutional quality assets for most minimum investments of $50,000, 50. So let me tell you a little bit more about this. So when I talk about institutional quality assets, in most cases, some of these operators are bringing assets that that banks and other mutual funds and other types of asset or investors or investment or family offices, for example, are investing in these types of investment opportunities. And typically the minimums may be 250K or 500K to get in. And for most people, that's a high bar to get into a real estate deal. But when it comes to these types of real estate syndications, what the operators can do, or fund managers can do, that you may be working with, they can then establish minimums that allow for retail investors to get access to for a minimum of $50,000. And the beautiful thing about real estate is, just like I talked about in that single family home, after you have, put a tenant in that property, you've renovated it perhaps, and it's generating cash flow after all of the expenses are paid, the mortgage, income, the taxes, insurance, all that stuff are paid. At the end, you have a little bit of cash flow from that single family home. Again, magnify that when you're talking about a 100 unit, 200 unit, 300 unit apartment complex that you're investing in, and then you're receiving your proportional share of the cash flows from that property. And that just gives you that cash flow opportunity, which is something that differentiates most investments. Yes, there are dividend paying stocks that can do those things, but in terms of the benefits that come with investing in real estate, the tax benefits that are available to investors who invest in these types of assets are greater than those who are just investing for purely capital gains. In the world of real estate, you can use things like depreciation, for example, to help offset the taxable income that your passive that the property is generating, to help essentially lower or eliminate the taxes that you're paying on that passive income from your real estate investment. So there's a whole lot of opportunity there.
Yeah, you bring up a good point, this idea of cash, because if let's say I'm in retirement and I need to take money out of my retirement accounts, if there's a monthly or an annual cash distribution from this syndicate, then I have some cash sitting there that I can use that instead of having to sell something when maybe the market is down or I don't have the kind of return that I was hoping for. I've got that cash that I can use then to take out. So
That's right.
you have that, or, if you're generating enough cash, it gives you cash to invest into something else.
Yes, that's right. And similar to, most people may be familiar with taking a 401k loan, for example, or maybe I'll take a drop back a step. So when you have a 401k, either through your employer or a self-directed 401k, or you can take a loan from that. So as we talked about earlier, you cannot directly benefit from the income that the real estate property is generating. That is not that is against the IRS rules. But if you are invested in real estate, and that real estate, as you mentioned, is generating cash flow and it's going into your 401k, you can take a loan from your 401k, and when you take a loan from that product, you can utilize those funds for different types of investments or different types of things that you want to be able to do there. So I did want to make sure that I can clarify that point for the audience.
Yeah.
Can you use the money that you're generating from the real estate syndicate then to repay the 401k loan, or does that still have to be
Yes.
made from outside asset contributions?
Yes. So when you are generating the income from the 401k, or excuse me, from the real estate property, you are the income, and you take a loan from that 401k, you are whatever income that you have outside of that. So just to be clear, you're going to use income, your personal income, to then pay back that loan from that property, from that you've taken for that. Now, let's say, if I could be more specific, let's say you borrowed from your 401k, to invest in a real estate property. We're not in this scenario, we are not directly invested into a real estate property with the 401k. We have borrowed from the 401k, let's say for 5% interest rate. And what we're going to do is we're going to then invest that $50,000 into a real estate asset that will pay us that will pay us 6% or 8%. Let's, just for the sake of numbers here. So that delta that we're talking about of 3% is cash flow that's coming to us. And that cash flow can be utilized to pay back the loan over time, plus what other additional resources are necessary to pay back that loan. And once that loan is paid back, however, all of the proceeds from there do become yours to then begin to utilize personally.
Yeah. So any money that comes out of it, if it's a loan, money that comes out has to be paid back. But if you're taking a distribution from your retirement account because you are in retirement, then that's basically your income.
That's right.
That's
right. That's right.
Yeah, that's considered your income.
That's right.
So a question for you. I know that there are a lot of folks who are listening who have had previous jobs and they've taken money out of their previous employer's plan and they've put it into, let's say, for example, an IRA, and now that IRA is sitting in a brokerage account somewhere and it's invested. Can they cash out whatever it's in? Let's just say, for example, I put that into an S&P 500 index fund, and I'm sitting there and I've got a couple $100,000 in my S&P 500 index fund. Can I cash out some of that and move it into a solo 401k and go through this process, or does it have to go directly from the employer into the solo 401k and then be invested?
No, it does not, and it can come in this. It can come exactly in the scenario that you described. What will take place when you work through this process with one of these providers of a solo 401k, for example, is that they will work with you to understand your specific situation, to understand, okay, whether or not your assets are eligible to be rolled over into the solo 401k account. And once they've gone through that process, the teams that most of the companies out there will provide white glove service to help you through that process. They will set up the entity for you that's required to be able to make this all kosher, so to speak. They will make sure that they facilitate the process with your current retirement, your IRA provider, and get on the phone calls with them and help facilitate that transfer from one institution to their institution, and the banks that are set up for this, so that the process is very seamless from there. And once that's all established, you will, just like you have your Bank of America account or Capital One account, you'll be able to have that account available to you that's set up for your 401k. And when you have investment opportunities that you are able to evaluate, you'll be able to use that account to then invest into these different projects.
Gotcha.
Do they, they're not the ones who are finding the projects for you. They're the ones who are just it's kind of like they're almost, for lack of a better way of saying it, they become the custodian of this money, right? They're the ones who are basically not managing it, but they're the ones who kind of put it all together in a package for you to use. Similar to when your money goes from your previous employer over to a brokerage account at Fidelity. Fidelity is now the one who puts it into a package for you to be able to use. This is just a different company that's putting into a package that can be used for other assets like a real estate syndicate.
That's exactly right. They're in the business of being able to get your assets, unlocked essentially from just exclusively being able to invest in mutual funds to being able to choose to your investments that align with your investor profile. So yeah, you may, even in a self-directed solo 401k, you may still decide to invest in some other mutual fund, but you can also diversify and invest in a real estate project, or perhaps you want to invest in some crypto fund that you've seen. You can then direct some of those funds into those things. And the beautiful thing about this, again, and you guys are really stressing this point, I don't want to miss this again. The the opportunities are out there and available, but it is important for the investors to do their due diligence prior to making any investment, so that they can know that what they're getting into based off of the information that's been presented to them is the right investment for them to get into.
Yeah, as you always say, definitely check out the fine print. So this sounds very intriguing, personally. I'm just curious. I'm going to play devil's advocate here. We have a housing crisis in America. Part of that is obviously due to not having enough houses. But for renters specifically, one of the challenges is you've got the BlackRocks of the world buying up all the rental properties and jacking up prices. As an investor in a real estate syndicate in my solo 401k, am I becoming like a micro BlackRock and like making housing more expensive for people who can't afford it?
Oh wow, that's a great question, and look, I appreciate that question. What I would say to you is that, in the society that we're in, we're looking to be able to actually help with contributing to a solution for the housing crisis. And let me explain what I mean by that. Yeah, the BlackRocks of the world and these massive asset managers, they are acquiring billions and billions of dollars of real estate. Many of those are single family homes, and that is contributing to the housing crisis and the shortage of affordable housing in this country. And however, when we talk about what we're doing within commercial real estate syndications and funds, as we're specifically speaking about today, what we're actually doing is we're helping to contribute to a solution to a problem. What we know out there is that it's substantially higher for those renters out, or those buyers out there, for them to buy a single family home than it is to rent, especially in the markets, in those growing markets that many of us know about. Think about the Charlotte, North Carolinas, the Dallas, Texas, the Houston, Texas, Nashville, in some of the markets that we focus on along the Sun Belt, Atlanta, Georgia, etc. These are places in high demand, and with that high demand comes a lot of attention to the available, whatever is available out there from a single family home perspective. But one of the things that is critically important to remember is that housing is an essential need for all of us. We all, when we think about Maslow's theory, one of those things that we need is roof or housing. We need that roof over our head, and so we're able to be a part of that solution as multifamily investors by being able to help provide clean, safe, and affordable housing for people who need it. They may not be able to afford that single family home that probably 5 years ago was within reach, but now with inflation, with the shortage in housing, which is driving up the prices of single family homes for acquisition or for rent, and higher interest rates, all of these things are making it very difficult for those would-be home buyers to get into that single family purchase. So what are they going to do? They're going to look to the solutions that you as a multifamily investor are providing, and that is the multifamily apartment complex where they can raise their families.
Now I can sleep better at night. Thank you.
Yeah. Well, it almost sounds to me like you're kind of being, for lack of a better way saying it, the anti-Jared Kushner of just being the slumlord.
I don't think there is a better way to say it.
The slumlords that own hundreds or thousands of units, and they have not put a penny back into these places, and they just look like shit, and the families are living in squalor, but they just keep on raising their rent. You're actually saying we're going to go in and make these places more livable, up to date, and find ways to reduce the costs and update them, rather than not update them and increase the cost, increase the rent.
1000%. This is a win-win-win situation. And so what I mean by that, when these typically these properties, when they are acquired, we acquiring them where they may not be the best run apartment complex. Maybe it's a mom and pop owner who's owned it for 40 years, and they just got tired and they stopped making the maintenance. Their potholes in the throughout the parking lot. The walkways are buckling, the landscaping doesn't look nice, and the pool's a little bit outdated. It's not that desirable community that people want to live in. And maybe there are hookups for laundry in the units, but they've never gotten around to doing those things. But when these investors and operators, we come together and we see these opportunities to improve these assets, it's not just about a pure capitalist, like, let's take everything and drive everything up. That's not what this is about. The win is, hey, we see the opportunity here to be able to improve this asset. We know that for all of the comparable properties in the market that we're looking at, that they have nice stainless steel appliances and they have nice amenities and they have the dog park, they have laundry hookups in the units. Let's go ahead and make this investment to our assets so that we can provide our residents with the same quality as what they could get in a 1 to 3 mile radius of what we are acquiring. And in that, yes, we will make sure that we are fairly charging the rents that are comparable to the marketplace, so that we can make sure that we're maintaining the property and generating returns for our investors. But this is not a price gouging exercise by any means, and it's not to squeeze every drop out of it and poorly run these places. The bad actors out there, those people will be exposed in the end, in favor of the people that are truly out there trying to make a difference in the communities that we're impacting, which this ultimately is.
Yeah. So I'm sold. Now, I want to take money out of my solo 401k or my IRA and move it into a solo 401k. Who's going to help me find these syndicates?
So what's great about this? Some of the solo 401k or IRA, self-directed IRA companies, actually they are full service providers. So many a times they will have, in addition to providing you with the tools and with the actual tool of that solo 401k or of that self-directed IRA, they will also have an online platform of different vetted operators that they have worked with, or that are a part of their community, and that they will may provide webinars and educational information for people to learn more about this. Oftentimes they are not soliciting there's no solicitation of deals within these communities, because that's a little bit off-putting for folks, that they're just in there and they're just getting pitched all the time. But there is an information share that goes on, so that people who are interested in being a passive investor into these types of real estate deals can go and explore these types of opportunities. And so they'll go in and they can learn about, hey, here's someone teaching about multifamily investing, or here's someone who's teaching about investing in self-storage facilities, or whatever type of asset class that they're interested in. And that is one way that investors can get exposed to operators who have these types of offerings that they may want to learn about. In addition to that, one of the ways that I got exposed to this was through two key ways. So one was through I was attending virtual meetups, or in-person meetups, and then the pandemic happened, and then I was relegated to doing all the online stuff, like many others were doing. And in that time, I got exposed to operators, people who do this for a living. This is their business, and I got exposed to this whole thing, and started learning about passive investment opportunities, and got involved in it from there, from based off of having conversations with people, learning about their track record, learning about their vetting process and their due diligence process that they go through to be able to determine what assets they are going to be bringing to their marketplace. On the flip side of that, another thing that I did specifically as a passive investor in particular was I started, attending conferences. I was going There are different real estate conferences that I was able to go to, and in that process, I came across different operators that have these types of offerings, and I can learn about what they were doing and build personal relationships with sometimes. So if you think about it, it's almost like dating. You're courting people and you're like, oh, what's going on, and how's it going. You get that whole process going on, but once you've done that, then it's a matter of time before, hey guys, here's our latest investment opportunity. It is a 142 unit property in Dallas, Texas. Here are the specific return metrics. Here's our business plan. Here are the risks that we see. Here's how we plan to mitigate these risks, and all the details that get laid out for you. And so you get a very robust prospectus and business plan that gets laid out for you to help you understand the investment, and then you get a chance to make a decision on whether or not you want to invest or not. But those are some of the most common ways that folks will be able to be exposed to these types of operators.
Bummer. I was actually hoping you were going to say you were going to do this for us. No, I'm just kidding. I'm just kidding. Obviously, you have a track record of doing this, right? And so,
Yes.
Folks, it's important to make sure that you do your due diligence yourself, right?
Yeah,
You're
absolutely.
finding
Read the fine
credible
print.
people. It's not just the first deal you come across. I mean, granted, it may be the first deal you come across is the sweetheart deal for you, but don't just assume that's the first deal that's going to be the right one.
That's right. That's right. There are some important things that investors when you're looking at, let's say, for example, we get it, we get off and we're learning about one another, like, man, that Chris is really great guy, and he seems pretty awesome. But when we have that next conversation, we start getting real about, hey, I'm thinking about really getting into this game of diversification into real estate. Maybe there's some questions that I want to ask Chris about being able to, about his investment philosophy or his team's investment philosophy and what they're thinking about. So, what are some things that you want to ask some of the investors that you're potentially courting, if you will? You're going to ask them about, tell us a little bit about the market that you're focused in. So when we talk about markets, we want to look at specifically growth markets. Okay. As I mentioned before, we're not focusing on places that are, my cousin Joey told me about this place and this is an awesome place to invest and you just got to dump all your money there. This is not what we're talking about here. These are very well thought out, data driven decisions on the market. What is the metropolitan statistical area of that particular MSA of that particular market that we're investing in? Is it growing or is it shrinking? When we think about the market, we think down to the zip code. What is the median household income? Is it in a landlord and business friendly state? So what do I mean by that? I happen to live in New York State, and New York State is not a landlord and business friendly environment. From a landlord perspective, for example, it takes basically an act of God to remove someone from the property, even if they haven't been paying rent for several months. And that is unfortunate because, yes, this is not a charity. It is a business, but if people have signed contracts to pay rent on time. If they're not doing that, then you, as a landlord, should be able to remove those people. Yes, you want to work with folks and certainly this does happen, and people work with people on an ongoing basis. But if people aren't willing to come to the table to work with you, then how do you remove those people so that you can get someone in that will pay the rent on time? Those types of things in states like New York and other coastal markets present a real struggle for investors. But in other municipalities and states where you have a bit of more landlord friendly environment, if someone is not paying, then you can legally remove them from your property. You go through the proper court proceedings, and within a week, a month, or whatever the case may be, that can happen pretty quickly. And then you can get the unit back up and running and on the market to be able to do those things. So market is a very important thing for people to think about. Beyond the market, you want to think about the type of asset class the asset that you are investing in. Are you looking at a property that was pre 1980s? Are you looking at a property that is from the 1980s going forward? Why is that important? Well, when you think about properties built before the 1980s, many of you may have signed those documents when you bought your homes about lead paint and pipes and all the different types of things that are there. These are things that to mitigate a lead problem that may happen in a pre-Civil War, a pre-war construction or an early or older asset. These can be very difficult or costly renovations for operators to be able to address, and that could be something that creates a level of risk to the operation that many investors, especially us, we don't particularly look for. So what do? We focus very much on assets 1980s and up, because we know that we're in most cases we are not dealing with those types of issues, and these are relatively newer construction, and pretty much we can enhance those properties by making some smart improvements to them, as opposed to those big heavy construction costs that come with the big renovations on older assets in some cases. So those are some of the types of things that we're talking about from a market. And then of course, when we think about the particular properties and the operators that we're working with, we want to make sure that we have worked with people who are focused on who have done this before. This is not something that is a new trick for them. They've been around the block. They've seen the different market cycles. They know how to invest in these things. And then the final thing that I'll say to you guys is, when you think about financing, we know that we've all experienced this over the past past few years, where the Fed increased interest rates 11 times in a very short period of time. And for many commercial real estate investors, many of them actually got exposed in this time because they didn't do something that was very savvy, which was purchase what's called a rate cap. Now, a rate cap is simply saying that I can pre-buy from the lender a cap that will make sure that my interest rate never exceeds this percentage. And so many folks didn't do that, and in the course of the 11 interest rate hikes, when their interest rate ballooned up so quickly, that actually eroded away substantially from the revenue that the property was generating, and it put those properties into distress, and has caused a big issue for folks selling pennies on the dollar in some cases, or having to walk away from investments and banks taking them back. So there's a whole lot of things that are happening there. So I just wanted to paint that picture for folks to help them know the types of things that are going on here.
Yeah. Right on. So if I'm interested, you piqued my interest, as David said, I'm sold. Where can I go to learn some more information to make sure this is a proper investment strategy for me?
Well, what I tell investors is, one of the things that I have available for investors is a free online training that helps people understand a little bit more about how this works. And so you can go to boostmycapital.com/investor-webinar, and that will get you to my free online training, which will help you learn about this space a little bit more. And then from there, if that's something that resonates with you, you'll be able to schedule time with me or my partners to be able to learn a little bit more about this. And I'm happy to answer any question that you may have. Hey, Chris, you talked about all this great stuff, but have you had any deals fail? Or have you had, what do you guys see about this? Or what about that? I'm happy to take those things on. I'm an open book. This is important for folks to know.
Right on. And how else can our listeners and viewers connect with you, either on your websites, books, social media?
Absolutely. So our website is boostmycapital.com. You can find us there. On social media, you can find me on LinkedIn, Christopher Price MBA. It's also Christopher Price MBA on Facebook, and I'm at The Real Chris Price on Instagram.
Right on. Awesome. Well, thank you very much for providing some more detail and context as to the strategy. David and I, our interest is definitely piqued, and we hope that our audience considers just another way, as you said, to diversify your retirement portfolio beyond just investing in the stock market. Because as we've talked about several times before, especially in this economy, we need to have multiple income streams, multiple types of investments, and real estate is a key wealth builder for Americans. So definitely want our audience to consider that.
Yeah, definitely.
Absolutely. Thank you guys so much for the opportunity. I really appreciate it. I'm forever grateful. Reach out to me anytime.
Of course. Thank you. With no fees or minimums and no overdraft fees, banking with Capital One is the easiest decision in the history of decisions. That's banking reimagined. What's in your wallet? Terms apply. See CapitalOne.com/bank for details. Capital One, N.A., member FDIC.
Thank you, Chris, for an informative interview. Thank you to our listeners and viewers for joining us for another episode. Remember to grab your Queer Money takeaway and resources mentioned in this episode from this week's newsletter. And remember, we did discuss some very complicated and deep topics in this particular episode. If you need more information or more help, Chris said he's available.
Then join us this Thursday as we dive deeper into successful retirement planning for queer folks, and next Tuesday for another discussion on making more money. Have a great week, and until next time, stay fabulous.